Hey guys, in this video we're going to be going through my reaction to an interview by Warren Buffett on CNBC. Now this interview was from back in February of 2018, so about 10 months ago, but it is still very relevant and there is a ton of valuable information in here. I think I stopped this video about 5 different times throughout it. So make sure you stick around to the end because there is a ton of valuable information throughout this video that you guys can hear from Warren Buffett, and then you can hear my perspective on what he is saying. So if you do enjoy this style of video, make sure you leave a like and let me know what you like about these videos down in the comment section below. Both of those things help me out a ton, but I hope you guys enjoyed this one. Let's jump into it.
Our special guest this morning is the chairman and CEO of Berkshire Hathaway, Warren Buffett. And Warren, we've talked about a lot of things this morning. We got briefly your thoughts on the markets, but there's been a lot that's happened in the markets since the last time we sat down with you. Volatility is back in a big way, and that has the average retail investor kind of questioning what to do at this point. It's scared a lot of people. What do you think's happening right now, just in terms of the return of volatility? Is it something to be worried about? What's causing it?
Well, if you own stocks like you'd own a farm or apartment house, you don't get a quote on those every day or every week or anything. You look at the business, and the value of American business depends on how much it delivers in cash to its owners over between now and Judgment Day, and I don't think it changes in 10% in a 2-month period if you're looking at it as a business. Now you've got anything can happen in markets. I mean, anything can happen in markets, and that's why I say don't ever borrow money against securities. That markets don't have to open tomorrow. I mean, you can have extraordinary events. So I think to some extent you can get some of the instruments that people don't understand very well that have a lot of firepower in them,
like
and
the volatility index
can
and
trigger.
things that are tied to that.
The idea of people taking a position, and they're gambling. They're not investing. Nobody's investing when they buy, some supercharged index on how the VIX does or something like that. They don't need it in their life. It's an unnecessary instrument.
All right, so he says a couple of things here right at the start that are really important. The first thing is that simply how much cash that a business can produce for you is how much it's worth. It's as simple as that, and that is the best strategy that you can use in investment, is to look over the long term and look at how much cash a business can produce for you. Now, of course, the difficult part of that is predicting how much cash a business can produce, and no one can predict accurately how much cash a business is going to produce each year for the next 10 years or even longer. No one can do that, but you can use conservative growth rates to get a ballpark conservative sort of estimation of how much cash it can produce for you. And if you can get that at a good price, if the price that you're paying for the business relative to how much cash it produces for you is good at a conservative level of cash, then if they're likely to hit that, I mean, they are likely to hit that if it's a conservative value, then you're going to get that return. And if they exceed it, then you're just going to make more money. So that is the simple strategy that you should be using when you're investing. And the second point he makes here is that if you aren't buying cash producing assets, if you aren't buying businesses or properties that are going to produce you cash, then you're not investing, you're just speculating. And this is really important. In order to, when you're investing, you need to make sure that you are actually investing and that you're not speculating. Investing is simply when you have a really high level of confidence in what return you're going to get on that investment. And in other words, that means you have high confidence in that the business is going to produce you enough cash in order for you to receive a substantial return based on how much you've paid for that business. In any other circumstance, you're not investing. That means that if you're investing in commodities or things that don't produce cash, like he was talking about the VIX index, which is basically just tracks the volatility of the market, that's not investing, that's speculating. And in the same way, if you're investing or if you're buying businesses that produce cash, but you have no level of confidence in how much cash they can produce, meaning that you just don't understand the business, or it's a new business that they have their cash flows all over the place, then that also isn't investing.
When you're just looking at the price of something, you're not investing. I mean, if you buy something, Bitcoin, for example, or some cryptocurrency, you're not looking to the asset itself to produce anything. If you buy an apartment house, you're looking at how the apartment house does. If you buy a farm, you're looking at the farm does. If you buy a whole business, you're looking at how the business does. If you buy a part of a business, why shouldn't you look at how the business is going to do?
Yeah, and he just reiterates it here. If you're buying Bitcoin or some other kind of currency or commodity, then you're not investing because that asset isn't producing anything. And if it isn't producing cash, then you can't value it. Because the value of a business, again, is how much cash it can provide you over its remaining life. If you're investing in something that doesn't produce cash, meaning you're investing in gold or Bitcoin, or you're investing in paintings or something along those lines, then you are just hoping that someone is stupid enough to pay more for it than you did. There's no value there. You can't calculate how much something is accurately worth if it doesn't produce any cash for you.
I think with Berkshire, we have an unusual number of people as shareholders who just look at Berkshire as a business. They look at it as a savings account. They put some money in 20 or 30 or 40 years ago. We retain it and reinvest for them, but we're their savings account.
Again, this is exactly how you should be looking at the businesses that you're investing in. Think of the business as a savings account. You're going to pay money in order to own that business. In other words, you're buying into the assets and the cash and all of the liabilities and everything that that business has, and you're buying into the management team that is going to be able to convert the assets within the business into something else. So if you have a really bad business, if you make a bad investment, then that company and its management team are going to turn $1 into 90 cents, which basically means that every year that goes by, they're taking 10 cents out of your dollar for you, which means that they're destroying your value. Basically, it's a bad business. On the other side, if you invest in good businesses consistently, you might find businesses that can turn $1 into $2 consistently. And that's basically the same as your savings account. You put money in the savings account and it turns into a little bit more money. And businesses are better, of course, because you can make much more. You can make much more than that 1 or 1.5%. You can probably make 10 to 15 to 20%. But of course, they are riskier.
If you buy a 30-year government bond, it has a whole bunch of coupons attached. In the old days, it does now, it's electronic. But it has a whole bunch of coupons. And the coupon says 3% or whatever it may say. And you know that's what you're going to get between now and 30 years from now, and then they're going to give you the money back. What is a stock? A stock is the same sort of thing. It has a bunch of coupons. It's just they haven't printed the numbers on them yet. And it's your job as an investor to print those numbers on. If those numbers say 10%, and most American businesses earn over 10% on tangible equity. If they say 10%, that bond is worth a hell of a lot more money than a bond that says 3% on it. But if that government bond goes to 10%, it changes the value of this equity bond that, in effect, you're buying. You are buying, when you buy an interest in General Motors or Berkshire Hathaway or anything, you are buying something that over time is going to return cash to you. Maybe a long time in terms of Berkshire, but it'll be bigger numbers. And those are the coupons, and it's up to you, your job as an investor, to decide what you think those coupons will be, because that's what you're buying, and you're buying the discounted value. And the higher the yardstick goes, and the yardstick is government bonds, the less attractive these other bonds look.
Again, Buffett reiterates this important investing strategy. It's really, really simple, but it is super important. The business's value is just how much cash it can produce for you, and your job is to calculate how much cash that is. So in terms of a bond, if you're buying a 3% bond, then every single year you're going to get 3% of the principal that you paid. So if you bought $1,000 worth of bonds, then you're going to get $30 in cash flow every single year until the bond expires, when you get the $1,000 back. Investing in businesses is exactly the same, except that you don't know what those cash flows are going to be, and your job is to calculate them. That is it. Now here he also talks about what he calls the yardstick, which is quite an interesting way of describing it. But what he's talking about is the opportunity cost of not investing in a risk-free bond. So basically, at any time in Australia or the US, you can go to the government and you can get a bond that will probably pay you, at the moment at least, around 2.5% to 3% per year for the next 10 years, if you lock your money up for 10 years. And because that is risk-free, it basically means that if stocks were offering lower than 3% returns, meaning that you invest in the business and you get a 2% return per year for the next 10 years, then there is no way that you would take that investment over the risk-free investment. Because why would you take a risk to get a lower return than what you could get for risk-free? So basically the risk-free rate determines the price that people are willing to pay for risky assets such as stocks. So let's now imagine that you could get 10% on a bond. So you can get 10% from the government risk-free. Then anything under 10% for a business, any return that you could get for a business that's under 10%, you would not be willing to take. And considering right now the return that investors are demanding on stocks is about 10%, and the demand that people are getting, that people are getting from the risk-free rate is about 3%, that would mean that if bonds went to 10%, people in the stock market might demand 20 or 25% from their risky businesses. And in order for investors to make that 20 or 25%, they will only be willing to pay a much lower price. And that means that as interest rates rise, it puts downward pressure on stock prices, because as bonds go up, bonds slowly look better and better and better because they're offering 3, 4, 5% now. And less people are going to be willing to take the risk, and they're going to go, forget the stocks, I'm going to sell all my stocks and just buy bonds because I can get 5 or 6% from bonds. It's risk-free and it's safe. So that's how the relationship between the official cash rate set by the Reserve Bank or the central bank of your country, how that can impact stock prices.
Some people should not own stocks at all because they just get too upset with price fluctuations. If you're going to do dumb things because your stock goes down, you shouldn't own a stock at all. No, I mean,
what are dumb things? Selling a stock?
Yeah, selling a stock because it goes down. I mean, if you buy your house at $20,000 and somebody comes along next day and says, "I'll pay you 15," you don't sell it because the quote's 15. You look at the house or whatever it may be.
I absolutely love this point, and this is the last clip that I've got from Warren Buffett. And he basically says that it's just stupid for you to sell a stock if it's falling. And I'll sort of explain why. He explained why a little bit there. But really, the stock price of a business is just the latest price that someone has been willing to pay. And that price is often has nothing to do with what a business can produce. When there's high optimism, that price will be way too high for how much cash that business actually produces for its owners. And when we're in an economic downturn or a recession, businesses will be so cheap that you can get massive cash flow from a business for a really, really low price. I have never understood a stop loss order, which is where if a stock price falls below a certain price, it automatically sells your stocks. The logic of that just doesn't make any sense. Why would you sell a stock just because someone is willing to pay you less for that? Just think of it as a house. As he said, if you have a house for $100,000 and then the next day someone offers you $80,000, you wouldn't sell just because they're offering you a lower price, that is the logic of a stop loss order. So that doesn't make any sense. And Warren Buffett says it there, if you're going to make stupid mistakes or make stupid decisions like that, to sell just because the market's moving down or to buy just because the market's moving up, then you shouldn't be investing, because you clearly need to be able to distinguish between the market, which fluctuates up and down based on optimism and pessimism. You need to push that aside and look at individual businesses and how much cash they can produce. If you can do that, then you're going to be very successful, because when the market is down, those businesses will be producing similar amounts of cash, but they'll be cheap. And when they're high, those businesses won't be attractive and you won't touch them. And as a result, over time, as the market moves up, you will just make a very, very substantial return. The moment that you let the price of a stock dictate your decisions, meaning that you sell just because it's falling or you buy more just because it's going up, the moment you do that, you've lost, because the price of a stock is the consensus in the market. And in order to beat the market, you need to go against the consensus, meaning that you need to say, even though the price is falling, the value of the business isn't. And I'm going to buy while everyone's getting out. And when the price of a stock is going up, you're going to say, it's more expensive now, but how much cash the business can provide you hasn't changed at all. Therefore, I'm going to sell it to someone who's willing to receive a really low return, and I'll buy it back when I can get a better return on it. So that's all I had from this interview. There was a few other parts, but a lot of them were just repetition of the same things, and I already had a couple of points that were pretty similar, because he basically talks about the same things over and over again, because it's a simple investing strategy. Calculate how much cash a business can produce for you. Be accurate in those calculations, meaning that you need to know that you're investing in great businesses that are actually going to produce that cash for you, and then calculate how much you're willing to pay for that cash. It's really simple, and he reiterates it over and over again, and I really like these interviews because he just says it as it is. But I hope you guys enjoyed this one. And if you did, make sure you leave a like and let me know your thoughts down in the comment section below. If you're new around here and you want to see more, of course, hit that subscribe button and join the team. But I hope you guys have a great day, and I'll see you in the next one.